Teladoc, TDOC, has just reported after hours. Let's pull it up right here in our software. They're up 7%, and I'll be honest with you, I have no idea why. They reported 45 cents in earnings per share versus an estimate of 57. They reported $611 million in revenue versus $610 estimate. They beat by $1 million in revenue.
Why.
What was that?
I know why.
Why?
You don't understand disruption.
Is this a Cathie Wood disruption?
Yeah.
They also reaffirmed guidance of 625 to 640 million versus 637 estimate, but they're expected to lose money next quarter, right, Mo?
Yep.
All right. The stock is down a lot. It was a high of 155 in the last year.
Wow, look at that chart.
Oh, no, it was 295. Oh, my God. It was 295 in February of 21. No wonder Cathie Wood had it. All right. So it's down only 90%.
That's not bad.
Yeah, only 90%. And for those of you out there who are going to be keyboard warriors, yes, I have stocks that are down, but it took a 30% down in the market for me to have stocks that are down. I actually have stocks that are up still. So cool your horses. Don't sit there and try to compare Peloton, Palantir, and Teladoc to investing in BABA or Meta or something like that. And I bought BABA way, way lower than the 350, the 310 high. I bought Facebook way lower than 350. So
you can direct those comments at me on Instagram. I'd be more than happy to toy with you.
Yeah. So anyhow, Teladoc doesn't make money.
They do not. To be honest with you, I don't understand the quote unquote disruption in this area. Like,
well, for starters,
okay,
they disrupt their shareholders.
Touché.
They have 195% more shares outstanding today than they did 5 years ago. That's not double, that's triple, guys. For those who don't know your math, because 100% would be double, so 200% is triple. They have no ROIC. That's sick.
So they are a virtual health provider
which I believe in, by the way.
I totally believe in it, but this is not a novel idea. The Cleveland Clinic has been doing this for a very long time. A good friend of mine who's a physician there, he was kind of the one that got this campaign kicked off at the Cleveland Clinic. I just don't see the disruption in this space. This has always been one of those ones that just kind of confused me a lot. Especially I spent time in that industry before I left it, and even working at your dad's clinic and stuff. Everything on the computer is working perfectly fine with EMR. What's the big deal that's going on?
Well, isn't this all about, seeing a doctor, a virtual? Hey, listen, I'm a big believer in that. I want that. Just like I was a big believer in the internet 20 years ago. I was a big believer in real estate. I still am, but I don't want to overpay for companies.
I agree
so that's the question.
I just don't see why you give this thing a $50 billion valuation.
Well, let's see. What are the revenues for the last 1 year? 2.3 billion. So 20 times sales. No, it's 2 times sales. Okay. It's actually pretty reasonable for a software business with a gross margin of 68%. So guys, I'm going to sit there and say something. Based on the price to sales ratio, this seems pretty reasonable. Now, the question you have to ask yourself is, how much money are they going to lose along the way to profitability?
They haven't made money yet.
That's the question. It's like Palantir. Palantir at 40, I said, this is garbage. Now they're free cash flow positive. They're starting to show a lot of promise. It's at $8. I like it at a lower price than 8, but not far lower than 8. I look at that going, okay, because the price to sales ratio is making sense. This is why I like using the price to sales ratio on companies that are losing money. But the question you have to ask yourself is, how much money does it need to lose before it becomes cash flow positive on the year and steadily?
And they haven't.
They have cash flow positive in the last year, by the way.
There's a difference between share dilution and doubling your amount of shares in 2 years.
Well, yeah, true. There's a difference between a stock split and doing that. Let's go to analyst estimates. Oh, boy. Oh, boy. Oh, boy. Oh, boy. Boy, they're going to lose money hand over fist. Guys, I'm out. I'm not even going to analyze this company. Guys, my goal, if you're new to this channel, I have to see a path to profitability. I have to see some sort of realization. There's 2 ways to finance losses and finance a business: debt and equity. So if they're going to continue losing money, that's fine, but they're either going to dilute you as an owner, or they're going to riddle this company with tons of debt. My guess is they're going to sit there and say, listen, everybody's overpaying for us. Let's just give them more and more shares. Now, granted, they're only selling for 2 times price to sales ratio. Now, keep in mind what that means. Let's look at Microsoft. Microsoft, a business with similar margins, 68% also, they're selling for 8.7 times sales. Now, I don't think Microsoft's worth what it's at today, but let's say it even goes in half. It's still 4.35. And guess what? If Microsoft fell in half today, I would sell most soul to get the money to go buy Microsoft. So That's my point about it. Like, they're selling for a cheap price to sales ratio, but that's not enough. You need to be able to see that path to profitability where they're not going to dilute you like crazy or take on tons of debt in order to get there. Because let's say they have to go double your shares, double the shares outstanding in order to get that again. It's going to dilute the crap out of you. Now, I'm glad they reported 45 cents in profit versus 57, which is great. But at the end of the day, guys, we're investors. We look at every investment as the present value of all future cash flow, right?
Yeah, and look at the comparison. Let's compare it to the last video we did. Facebook just reported earnings.
Meta.
They didn't report the greatest earnings in the entire world, but we're looking at it saying, okay, there's something behind this. There's still user growth. They're still making money.
And it's big, albeit small, but that's what we like. We like with the story and people's reaction to the story are big disconnected. People look at it and say, they're not growing 20% a year anymore. We hate them. Okay, but we look at it saying, hate them more and more. They're still a growing business with growing EPS estimates for the next 5-6 years. All right, I'm okay with that. People are still messaging me in our chat. 6.5%. So if this makes sense to you guys, I want you to do one thing for me. If what I'm saying makes sense to you, and if you believe that buying a stock is buying a piece of a business, and you believe that every investment is the present value of all future cash flow, whatever you're going to receive in the future, you have to bring it back to today in a certain return, and that's the return you're going to make. If you believe that, then you need to do me one thing. You need to hit the subscribe button. You absolutely have to. We do 2 or 3 videos a day. During earnings time, we do 4 or 5 videos a day. We're very active. Mo and I, we have a great process. You'll walk away understanding money a little bit better. I love doing the videos. We're going to do this for the rest of the time. And we're one of the 2 financial channels that have been growing, the other one being Graham Stephan. So I give us a lot of credit. We're still growing as everybody else is decreasing because 2 years ago and last year, when we were talking about how things were massively overpriced and people called us stupid, we sat there with a little redemption and there's more to come, guys. This market isn't done yet. I'm not trying to be a fudster. I'm not trying to sit there and say, put fear, uncertainty, and doubt in you. But trust me when I say this, when markets fall more and more and more, I'll be the one guy saying, guys, this is a good time to buy.
Yep, absolutely.
So subscribe to us. Thank you very much for your time.